within the country themselves. And at the most, just as you've been saying, at the most, when looking abroad, when looking to the euro context, the explanation is embedded in a current account problem. But at the same time, like parallel to that, I keep remembering this literature on too much of a good thing, and I'm like, we're missing something here. I'm not saying that you know, that the too much of a good thing literature would invalidate the other causal relationships, but that at least it has to be taken into account, you know, like on top of the others. I have the same hunches that the literature on East Asia has explored before, but I don't know how to, you know, like gross inflows matter, not just net inflows, because gross inflows sort of speed up credit booms. So, you know, credit booms are not just based on lax surveillance, but actually it's because a lot of people is lending money to you. So I don't know.
Yeah.
I can't go, you know, on. I don't know. But it's basically the logical relationships that I've seen applied to Thailand or Malaysia that I have not seen enough of for Spain, or I have the feeling that I have not seen enough of. Whereas for Thailand or Malaysia, it was mainstream knowledge. Really, it was mainstream. It was not something outrageous or weird, or you know. I don't know. And the second thing that I would like to hear a little more about is, I'm sure you have heard of, I don't know the authors, I'm sorry, but a not kind of recent IMF paper that says that a lot of the current account imbalances now, yes, within the euro area, I mean the imbalances for Spain or Germany, like surplus or deficit, a lot of them can be traced back not so much to their bilateral relationships, but to external, like extra Eurozone relationships. In particular, I read this paper a while ago, but as far as I remember, in particular to kind of asymmetric adaptation, so to speak, to China or other important traders in the world, right? So like Germany would have a booming surplus, not so much because of unit labor cost vis-a-vis Spain, but because it's got the productive structure and the technological ability to face expanding demand from other extra European countries, right? So I don't know how, I mean, I don't think this, again, contradicts your final conclusion, but I would like to know how it fits in this, basically, yeah, your final conclusion, like adjustment should be not only on deficit. Yeah. Sorry.
What is the habit? Do I answer or do we collect questions?
I think you better ask her questions because they have been quite long. So
yeah.
I'm sorry.
Start with the second one.
Okay.
Yes, there's quite a bit of literature, in particular coming out of Germany, emphasizing that German exports in the meantime are not with respect to other euro area member countries, but it's really external. It's essentially Asia and the US, and therefore Germany can't be the cause of the problem. Now, in the year 2007-2008, that was not the case for Germany. 2/3 of the German export surpluses at that time were probably not euro area but European Union, and the euro area would be somewhat smaller. But even so, I'm not convinced that the argument holds. No? I mean, the argument that we need higher wage growth in Germany in order to rebalance European trading balances does not rely on the balances being bilateral within Europe. I mean, it can well be that Germany is exporting to China, and if Germany had lower unit labor costs, Spain would be exporting to China. So I don't see that as a logical requirement. What has happened since the recession, since the crisis began, is that I mean, Germany is very busily trying to remodel the European Union after its own image, not necessarily saying after its own reality, but after its own image, in the sense that In 2007, 2008, the euro area essentially had a balanced current account with the rest of the world. The euro area now has 3-4 percentage point surplus. It sort of tries to play Germany, and of course more than half of these surpluses are German surpluses because they're growing, and German surpluses essentially have not come down. So in other words, the problems that in my view Germany has exported for a long time within the euro area, now they're exporting to other countries. In a way that's maybe not so bad because China is in a much better position to react if it ever wants to react. It has its own currency, it has its own policy, and Germany can't tell it what to do. Yeah, but so I don't think the extra European trade undermines the basic of the argument. I understand that a large part of where Spain has sort of rebalanced its current account is with respect to Latin America. But again, there, well, if unit labor costs were different, it might be that Germany would be going after these markets, or if not Germany, maybe Italy. So I think again, that does not, I don't see why that would undermine. Now, there is, and that is sort of one step to your other question, which is quite a bit bigger. There is a quite interesting literature that points out that unit labor costs are not necessarily the relevant cost variable for the exports. And the reason for that is that each country is producing tradables and non-tradables. And some body of literature, also a recent, well, not a working paper, but some policy brief of the ECB has calculated that the cost increases or unit labor cost increases of the manufacturing sectors in the southern European countries was a lot less than the overall increases in unit labor costs in these countries. Thus, the unit labor costs in all likelihood overstate the loss of competitiveness. Which may be why we don't get the full effects, observe the full effects that we had estimated. So I mean that's something that's worth pursuing, and it actually does relate to your first question. That's about the capital inflows. I very much share your sentiment that one would need a lot more research on that, and that the inspiration from that is essentially the one on capital bonanzas and capital flow reversals on emerging economies. And in the European context, I get what that means is if you think again of the economy be divided in tradables or non-tradables, or in tradable and non-tradable assets rather than products, then if you have a capital inflow, what you'd expect is a higher increase in the non-tradables, which for practical purpose would be real estate in particular, or non-exportables. And that, of course, in the medium term would push up the unit labor costs in that country, because once you have higher property values, at some point wages have to go up if real wages, nominal wages have to go up if real wages are to maintain the purchasing power. Some ECB and IMF papers are effectively telling that story, but they are not telling it in terms of speculation, but they are telling it in essentially the monetary unification lowered interest rates, and that gave a temporary boost to certain sectors like the construction sectors, that's the non-tradables. But it's not that the capital flows actually do silly things or blow up bubbles or anything of that sort. Right? So I guess that's the twist that I would into it. How could one investigate empirically? I guess there's two ideas that I'm toying with. One is that one follows up more systematically on the tradables, non-tradables, and in particular looks at which of these non-tradables one can tie to asset price bubbles. And the other one would be to think of it as a reduced form equation, because if you have the current account and you don't know whether it's due to trade factors or to capital flow factors, if you have some variables that shift either the export-import functions or the capital flow functions, you sort of should be able to split it up. And the unit labor costs would be very much on the trade side, and stock market prices or real estate prices, I would think, would be very much on the capital flow side. So I guess that would be how I would approach it, but I have to admit I haven't written that carefully. It's speculation.
Okay, more questions?
Not a question as such, just a comment about Spain, particularly on these current account problems. It is a funny thing that Spain, which has had a much higher unit labor cost than Germany in the past 20 years, 10 years, even 5 years, well, not in the last 2 or 3 years. The Spanish export performance has been better than the German one. This is a funny thing of the Spanish economy. So it was very clear in the early 2000s that all the comments about the Spanish labor costs higher than Germany, for example, were not corresponding exactly to what was happening in the economy. And the reason is what we were commenting about, the difference between export prices and import prices, and export costs and import costs.
Yeah.
The Spanish export companies, the unit labor costs in the 2000s, they were decreasing because the productivity was enormous. The rest of the Spanish economy, because we were adding just a small amount of money salaries, not productivity as such, that is a word I don't like in the short term, because in the 2000s we were adding very cheap salaries. The whole amount of the wage of the economy was not growing, so the economy was not growing, and you could say productivity is low. And that's why labor costs in Spain appear high. So, of course, we are talking about not very big difference in labor costs. 10 or 20% is not too much. No. For us, that we are more or less accustomed to the international trade, we can lose or gain that competitiveness just with a rate of exchange. So it's a big problem to solve these questions, because in Spain it's a peculiar country, and also we don't know very well the situation in Germany. Germany is an incognita, how it works as such. For more than I have been trying to know how Germany works, it's an incognita we have. And we have it in the middle of Europe. So it's a big problem. In short, Europe is much higher wage growth, it is clearly. Not only in Germany, in Spain too. No, we have a lot of debt. So we should grow out of the debt because of high salaries. In fact, all the world needs a high salary rise. Anyway, and another question. In the years you have used to calculate your data, I think there are two kind of regimes in that data. One regime up till 2006, in which the cost of oil is very low, practically gratis. And from 2006 till now, the price of oil is very high. So in Spain, the price of oil more or less accounts as from 2005 till now, more than 30–40% of all the current account deficits. So just to see that probably we could have got an easier adjustment in Europe if the price of oil were as it was 10 years ago. We were happy in Spain in the 1995 to 2004 because the price of oil was very, very cheap. And now the situation is very complicated, not only in Spain, for all the world.
Yes, it's go ahead, yes.
Yes.
Answer.
Yeah, I mean, what you said about Spain and the export performance is consistent with what we discussed earlier. I guess two thoughts on that. The first is, I suppose there's actually quite a difference between the various southern European countries. I mean, Spain actually seems to have a fairly robust industrial sector. Greece seems to be in a situation where the industrial sector has close to collapsed. So in that sense, the fiction of the southern European countries that have the trade deficit that I have used here is clearly an oversimplification. I also noticed that when I looked at the export price deflators for Spain, they actually increased faster than GDP deflators in the last few years when Spain was balancing its current account.
Spain, the prices of export of goods in Spain are much higher now than 10 years ago.
Yeah. So that would also speak against a cost-driven adjustment. I'm not sure how oil, the role of oil would modify the analysis that we have. I mean, we do have import prices in our ULC Phillips curve, and import prices, or at least their movement over time, is very much the oil price. So in that sense, it's a bit in their model, and it would anyways, I would think, affect the different economies in Europe other than Great Britain in a fairly parallel fashion. In terms of Germany, maybe a few comments. Germany has had quite substantial changes in its labor relations. Germany used to have a very organized labor market with a high degree of centralization of collective bargaining and a very high coverage of collective bargaining. And therefore it used to have a fairly compact wage structure. And what has happened, ironically, under a social democratic chancellor, under Schröder, is that effectively that system has been broken up. And Germany, within a decade, has created a quite massive low-wage sector that it did not have, that it hasn't had in the past. And that low-wage sector is primarily in the service sector. It's not industry. I mean, the export industries in Germany are actually, for the most part, still paying fairly reasonable wages. But the domestic service sector, Germany has had, according to the OECD reports, the largest increase in income inequality in the last 10, 15 years. And that's not the top 1% taking off to nirvana like in the Anglo-Saxon countries, but that's really the bottom of the labor market falling down. And in the meantime, that is increasingly also affecting industry. I mean, it is probably related to German unification and the fact that Eastern Germany or the eastern parts of Germany never had a strong collective bargaining tradition or unions, and thus there's a substantial non-unionized sector, non-collective bargaining sector emerged there, and that is now also undermining Western German labor relations. The other important thing about Germany is that they have done huge expansion of their, if you want, international commodity chains. They had big foreign direct investment to Eastern Europe, and in particular the German metal and automotive industry is very heavily intertwined now with its subsidiaries in Poland, Slovakia, Czech Republic, Hungary, and so on. So in a way they have created their own little Mexico, what the US had as the cheap labor infrastructures, the maquiladoras. They've created in Eastern Europe. And I mean, I hadn't seen an analysis along the lines of what was sort of the segmentation of the working class versus what was outsourcing, but they would be interesting to look at for sure.
More questions? I would like to comment on what he said before about the fact that we don't only need higher inflation in the core Eurozone countries, but we also need higher inflation in peripheral countries, paradoxically, because of this high level of indebtedness in both the public and the private sector in deficit countries, in peripheral countries. So I think that the problem is, so we don't only need to shift aggregate demand, as it were, from core Eurozone countries to peripheral Eurozone countries by having higher wage growth in core countries, in particular Germany. But we need, because of this high level of indebtedness, the only way that aggregate demand can expand, in particular domestic demand can expand in peripheral countries, is through higher wage growth and higher inflation that shifts income and wealth from creditors to debtors within peripheral countries. So I think this problem makes the solution even more difficult, because in order to have these two effects coming about simultaneously, we would need to have a much higher inflation target in the Eurozone. So that means that the ECB would have to accept like a 3 or 4 percentage points increase in the inflation target for the whole Eurozone. And I don't think that the ECB would be willing to accept that. But in any case, it is a political decision that could be made. But, so I think the key issue is this shifting of aggregate demand from the core to the soft, to the peripheral countries. But we need to remember that there is also this indebtedness problem in peripheral countries. So we need also higher inflation in peripheral countries. So I think that the technical solution to this problem would be through a higher inflation target in the Eurozone. But this thing is quite unfeasible from a political point of view currently.
And the whole dialogue is very funny. 2 or 3 years ago, we were promoting austerity on the sense and wage deflation, on the sense that you get lower prices, you can export more. Now that the prices are not decreasing, or even we have the problem that there will be a deflation, and everybody says, oh, it's very bad. Anyway, this is what they were looking for the first time. So now that we have it, this is already bad. So the whole thing is just
quite confusing. Quite confusing.
No, supposing you promote wage deflation, well, you get lower prices. This is the idea. So you don't complain later on when you get them.
It wasn't really a question but a comment, but I will still answer.
Yeah.
Because I use it to talk about 2 things that I've not talked about. One was exactly what Alfonso said. I've looked at it from the point of view, at the Euro crisis, from the point of view of trading balances, and that's what has motivated the paper. Now there's 2 things that I've not talked about, but that, of course, in terms of economic policy are of paramount importance now. One is the debt overhang, and that debt really needs higher inflation and not lower inflation. And the other is how one can empower fiscal policy, because the present policy mix is one where on the one hand, on the southern economy, the Troika is imposing austerity, but also the interplay between European monetary policy and national fiscal policy sort of makes a lot of the instruments ineffective. So I want to say a few things about this. The first, I fully agree that the southern European countries have pursued what that's a bit more post-Keynesian now, and others have called a debt-led growth model, as opposed to the export-led growth model that Germany and others have pursued. Now, a debt-led growth model relies on increasing household debt, which typically is only possible if you have property price bubbles. And though this higher household debt leads to higher consumption growth. And in all these southern European countries, but also Anglo-Saxon countries, we do observe a sharp increase in household debt, and we do observe that consumption had been driving aggregate demand in the decade before the crisis. So these countries, to a large extent, have a private sector debt overhang. And the way to get out of that, if you don't want to have debt restructuring, and if you don't want to have a wave private bankruptcies is essentially inflation. And we, in a way, need a setting that allows that inflation to happen. And I agree that logically the only way that you could get that is if the ECB were to increase the inflation targets, but not by a percentage point or two, but say up 8–9%. Yeah? Then you could actually, then the southern European countries could rebalance, and you could sort of inflate away a debt overhang that's too high for the economy. The second point is about the interplay between monetary policy and fiscal policy. Europe has this unique structure where we have a European monetary policy in the European monetary system, but we have national fiscal policies and therefore national public debts. And that creates the awkward situation that when the central bank actually wants to stimulate the economy, so if the central bank does quantitative easing, as the private sector is not investing anyways, effectively in the US or in Great Britain, it ends up on the one hand being a big subsidies for the banks because they get very cheap money and lend it to the state, but then indirectly it actually feeds into government expenditures. It allows an expansionary fiscal policy, even as in Britain if we don't do it. But in principle, it would allow that mechanism, and in the US it very much has played that role. But if you have a structure like in Europe, where you have lots of different public debts, and the central bank does quantitative easing, even if the central bank were not austerity-minded, which it very clearly is, because it has intervened and called, I understand, the Italian as well as the Spanish government to remind them of what their duties is as a responsible government if they want to have ECB support. But even if it didn't do that, even if it wanted to support governments, it's still the case that the private sector in Spain, if it wants to hold a safe financial asset, it still has the choice between holding German government bonds and Spanish government bonds. So the implicit link between a central bank that on the surface only wants to support the banks but not the government, and the government that is able to do fiscal policy is broken in the European system, because those governments that would need most the injection from quantitative easing, it's not getting there. So Europe, I'm afraid, has several problems at hand here.
Okay, if there are no more questions, we'll stop this point. And so I would like to thank you again for giving this wonderful presentation.
Thank you.
I hope you will be back soon in the future. Okay, so let's have an applause for.